Also joining us, our alpha manager for the day, Rakshit Ranjan, portfolio manager at Marcellus, is with us now. Rakshit, good afternoon. So you know what, this market's just gone up one way, and we are all discussing how it's being driven essentially off late by the kind of retail and HNI flows. But your thoughts on the health of the market right now, and what should be the portfolio approach?
Yeah, I mean, the markets have clearly moved against many investors' expectations, given the kind of prices surrounding us. But that's the nature of the markets in the short term. They are driven by liquidity, and they're driven by sentiment a lot more than fundamentals. But having said that, I mean, the way to position a portfolio, according to us, should be to begin with around companies where fundamentals are so strong that in a month or two, even if their share prices go down or up, whether the market goes down or up, it shouldn't matter much. Provided you have that sort of an approach to portfolios, it doesn't matter what the market is doing, and hence largely for us, for instance, what the market has done over the last month or two hasn't changed our approach towards portfolio construction.
Okay, well, yes, you're in it for the long term, Rakshit. Good afternoon. So I guess you continue. But let me ask you about the trends. I mean, we know about your big bets in the large financials. We know how sort of heavily tilted towards consumer most of your portfolios are. On consumer itself, I want to understand, what are you doing now? Because the market has been running away with this whole agriculture or rural consumer themes. You still have a lot of urban stocks like Page Industries in your portfolio. So what are the thoughts here?
Yes, we do have some like Page, which are more urban than rural, but then all of these companies sell products which are small ticket items of day-to-day essential consumption. So they are not aspirational, they are not large ticket discretionary demand-oriented products. And a large part of the story for someone like, let's say, a Page or a Nestle or a Relaxo, etc., is in their expansion over a period of time to the smaller cities, to the rural areas of the country. In particular, after this sort of a crisis, for instance, there's a massive acceleration and shift from unorganized to organized, which is already happening and likely to continue. And as more and more unorg to org shift happens, I think you'll see many of these small ticket day-to-day essential product categories being not just urban centric, also become sort of tier 3, tier 4, and rural oriented. So from a sustainable earnings growth perspective, I think. But yes, if you were a cyclical philosophy oriented investor, then there might be core rural focused companies in some sectors, like say tractors or two-wheelers, four-wheelers, etc., which might be better cyclical bets on the rural recovery.
Okay, in fact, that was my next question, so I'll not ask that. Let me ask about some other sectors. Telecom or stocks.
So not companies providing telecom services, because our view is that despite this sector already over the last amongst pretty much all the players that are out there in terms of converting that subscriber base growth into profitability and cash flow growth. So when there's not enough returns on capital employed above cost of capital, hence no free cash flow, and there's no growth of profits, there might be a lot of volume growth, but if cash flows don't grow, then it doesn't attract us, and hence we don't have telecom service providers. But having said that, almost all companies in our portfolio, let's take the example of say a Bajaj Finance or an Asian Paints, etc. All these companies are benefiting immensely from the telecom penetration increasing, from the availability of more and more data as people use more and more of telecom in this country, etc., and building moats, building fortresses around it. So in a way, it's more of an indirect approach towards technology and telecom rather than a direct one of buying into telecom providers.
Okay. Also, Rakshit, of course, the next event for the market is obviously the earnings season. The IT sector will kick it off. And I've never seen too many big IT names in your portfolios. Why is that?
One simple reason being, our aim is to pack the portfolio with as many companies as possible which can deliver a sort of 17, 18, 20, 25% CAGR in earnings compounding. The IT sector does have some very, very good companies, and in some of our advisory portfolios, we do have one or two of them. But where we are looking for 18, 20% type of an earnings compounding, the IT sector on a constant currency basis doesn't give us enough candidates, and hence we don't have them there.
Has your confidence been shaken in stories like, say, a Relaxo, Rakshit, because of the lockdown and the impact? I don't remember, for example, wearing too many footwear of late. So I'm guessing that there would have been quite a bit of slowdown.
So what, for instance, in the case of this specific firm, the management team has said is that there's so much demand compared to what they can supply that the channel has run out of inventory. So it's actually quite the reverse. And honestly speaking, small ticket footwear is not the only category where we are actually positively surprised by the pace of recovery. And Relaxo does fit into that category of positive surprise on the pace of recovery. It's more about, I think, as I said, a massive unorganized sector being there in footwear. So I think 70 to 80% by volume, if not more, of the entire footwear industry is unorganized, right? And hence there's, for someone like a Relaxo selling 130, 140 rupee per pair realization on average to the customer, that sort of a ticket price doesn't get massively adversely affected because it's more utility oriented demand, but instead does get massively benefited by many of the unorganized players finding it difficult to survive through the crisis. Many competitors of Relaxo facing lots of challenges with their own balance sheet, with their channel's balance sheet, because they rely on wholesale channel, they rely on not so well funded distributors, etc. And hence, there's actually a massive market share gain story here of unorg to org and from organized competitors, which might actually be resulting in post-COVID growth rates being better than what they would have been without COVID over the, say, next three to 4 years. But certainly, 1 quarter, 2 quarter, I don't expect the June quarter numbers to be reflecting any of these trends. Because April was a complete washout and it was a recovery, not a complete growth period for May and June.
Okay. Rakshit, just hang on for 1 second because we're at 3 p.m. So let me just toss it to Anuj to see if there's any expiry play. Then we'll take a final word with you. Anuj, we've actually moved slightly lower, 85, 86 points up on the Nifty now. What thoughts? Bank Nifty still retaining about a 1% gain, but how do you view the action?
I think today's been clear day of option writers, Surabhi. I mean, since morning it was very clear that even though you had a market rally, like I said, only if you were deep in the money, which is like 10,650 or 10,700 or perhaps even 10,750 call, you would have made money. But if you even ventured out to 10,800, you would have lost money, and option premiums are down anywhere between 75 to 99%. This does bring us back in the range now, though. Now I think we've got a beautiful range to work with, which is the 200-day moving average on the way up, 10,885 thereabout. Also perhaps yesterday's high and yesterday's low, which is about, say, 130 points lower from here. I think the market will make a decisive move once both or any of these sites is taken out, perhaps as early as tomorrow or next week.
Okay, that's the expiry, the weekly options as it's playing out right now. Rakshit, final thoughts then. A lot of people probably have that missed out feeling in this rally because they were waiting for that dip which never came. What would be your final word of advice before you leave us today?
I mean, our word of advice obviously will come from our perspective, which is based on the policy, philosophy that we follow. Which is that provided you've invested in companies where earnings compounding isn't getting adversely affected by an event like this, then it's actually futile to wait, and you've not missed out on the growth runway, which is ahead of us over the next 3-4 years for these companies. So even though you might be entering at 5-10% higher, that's not going to kill the compounding engine that you're banking upon. Just like let's say over the last 3 years, the markets haven't done much, honestly speaking. They haven't compounded at a 20% CAGR. But there have always been portfolios and companies which can deliver to you over a period of 2017 to 20 as well, or 18 to 20 in particular, a very healthy growth compounding. So yeah, provided you are with the right types of stocks, the fear of missing out shouldn't be bothering you.
Okay, Rakshit, we'll leave it there today. Thanks a lot for joining us. Good talking to you. We will take a break on that note, and we'll come back with the BTST calls.